confirmed. Furthermore, changes have been made to the country's dividend tax structure. The previous flat 10% tax rate on dividend income has now been replaced with a split structure. Dividend income will be taxed at 5% for shareholders holding at least 10% of a company's capital, while all other investors will face a 15% tax rate. This update comes after a deal between India and France in December 2025, where both countries agreed to revise their 1992 treaty. The revision aims to halve the tax on dividends paid by Indian units to French parent companies. Meanwhile, these changes reflect India's ongoing efforts to strengthen ties with France and streamline its tax policies. Now joining us live is Dr. Ajay Dua, who is the former Secretary of Commerce and Senior Economist, joining us from Delhi. Thank you so much for joining us, Dr. Dua. Do you believe that these latest changes will facilitate further investment between India and France, given that Modi and Macron have designated 2026 the year of India and French innovation?
Thank you for having me in this discussion. I'd like to start by mentioning that last week when President Macron happened to be in India on a state visit and thereafter to attend the Global AI Summit hosted by Prime Minister Modi, they signed a host of agreements to amend certain existing laws as well as to enter new arrangements of cooperation, and the two all put together, the two heads of government said, we have now moved into a level of strategic partnership between the two countries from what was earlier probably a less strategic or what would one say, a common kind of a partnership. Having said that, they signed about 20 cooperation agreements were signed. One of these was to revisit the arrangements which exist today for what's called the MFN, Most Favored Nation Agreements, the arrangement which exists that, what the MFN is really, that if a country which is a signatory to the MFN arrangements lowers the taxes for one country, this will automatically apply to others as well. That means there was an automaticity that and that's a WTO endorsed arrangement and probably even precedes before the WTO was set up. This arrangement was struck down in a particular case by the Indian Supreme Court. It happened to be a case of Nestle, the Swiss company, that unless the Supreme Court of India had said that unless it's specified that who is going to be the beneficiary of the MFN arrangement, automatically the country cannot claim, and the country which is seeking it cannot ask for it unless it's been put in black and white. So to get over the Supreme Court of India's ruling during President Macron's visit, the government of India endorsed the idea that MFN, France, the jurisdiction of France is covered by the MFN arrangements between India and France now. So if India gives a benefit of a lower duty to any other country on a particular commodity or a service, that will automatically apply to the French providers as well. And in the instant case, the issue before the French government which was raised was extending technical services to India under the mutual partnership, the bilateral partnership which is now going to be called. The three sectors which have been identified are defense manufacturing, aerospace, as well as technology transfer. So technology transfer between the two countries would get facilitated now that the technical services have been covered under the MFN. That's number one. The second arrangement, which was also made during this visit, was with respect to the dividend tax. The French companies, the French government had sought that, seeing that there is a bigger partnership in the offing, and in 2026, as you mentioned, would be the year of cooperation between the enhanced cooperation between the two countries, that there is the dividend which will be required to be paid by the companies in India set up with French assistance. That means the French companies have equity. If the equity of the French company is higher than a threshold limit, then the promoters of that, the people holding more than 10% share in that company, the French companies, will be required to pay only 5%. Whereas earlier the arrangement in India is a flat common 10% dividend tax applies to everybody. And I'm sure that the Indian government would have negotiated well. So they made a distinction. They said, all right, those people who are holding a higher holding, the French companies, they can pay instead of the 10%, 5%, but those who hold less than the threshold limit, they will instead compensate, and those small investors who are not really, say, a majority control, not, I wouldn't call it majority, a sort of a bigger control of the company, they will be required to pay 15%. So this meant the amending the treaty between France and India, on which we had entered into in the 1990s. Two changes made, as we just talked about. One, the application of the mutual most favored nation duty rates, now applicable to France as well, and in that the beneficiary is going to be the technical advisory companies from France. And second, the investors from France, who are the sizable investors, they would be required to pay only a 5%. It's a withholding tax, that whatever dividend you earn, the government of India was holding back 10% under the nomenclature withholding tax. That will now stand reduced to 5% withholding tax instead of the earlier 10%. And if you are holding more than, say, 10% of the company's equity, but if you are holding less than that, the French companies or any other French companies, basically, this will apply to them only. They will be required to pay 15%. These were the two changes and the context, as I mentioned.
All right. And do you believe that these changes will affect ordinary taxpayers in India and France, and not just the industries and the shareholders themselves?
I don't think so. This is applicable basically to the dividend lowering, splitting of the dividend tax at two rates will apply to people who hold equity in the subsidiary companies, which will be set up by the French companies in India. So indirectly benefiting the shareholders of the major companies, in case a common man holds stocks in it in France. Yes, some would flow, but not a direct benefit. Similarly, the most favored nation agreement of that the lowest import duty rate would apply to them would also be coming through an indirect route, but certainly because it will go to the people who are providing the technical services, the companies which are providing it, they can also get the benefit if India lowers it with anybody else, whether by way of a treaty or a general, that benefit will go to French companies. But as shareholders of the French companies, smaller people or a common man in France might benefit, but not directly.
All right, that's all we have time for. Thank you so much for joining us, Dr.